IE Business School, you may begin.
We are IE Business School and are initiating today our coverage on Santander with a buy recommendation at a target price of 3.76 euros, implying a 41.9% upside. Let's dive straight into the business and industry overview. Santander is one of the largest financial groups based in Spain. Thanks to its strategy centered around international diversification and numerous acquisitions, it has placed itself as the fourth largest bank in Europe. It is active in Europe, North America, and South America, with each of the region generating about 30% of the group's profits and the last 10% coming from its digital consumer bank. Aside of being a retail bank, which is more than 80% of its revenues, it also provides corporate and investment banking services, wealth management and insurance services, and PagoNext, a payment service. In terms of macroeconomic environment, we see it as being very positive for the banking sector, with South American rates at extremely high levels and North America and Europe expected to follow this hike trend. GDP and unemployment are also forecasted to reach more positive levels, in line with the recovery trends from the COVID crisis. These imply less need for provisions, thus further improving the bank's profitability. We issue a buy recommendation based on rate hikes driving net interest income in Santander's core geographies, a Spanish segment on the verge of a turnaround, a capital management that is misunderstood by the market, and Santander expected to close the valuation gap to its peers, leading to an upside potential of 41.9%.
Thanks, Kevin. We believe Banco Santander is better positioned than other European banks to benefit from one, the rising rate environment, and two, the loan growth picking up, thanks to its strong presence in Latin America, the US, and the UK. The pandemic has brought interest rates at another all-time low, putting the bank's profitability under pressure. However, the outlook for rates is improving, and we expect significant rate hikes in 6 of Santander's 9 core markets for 2022. With 64% of its revenue located outside of the Eurozone, Santander has a greater exposure to the rising rate environment than its Spanish counterparts. As you can see on the left-hand side, this is reflected by the positive sensitivity to rates in Spain, the UK, and the US, where we forecast rate hikes to trigger a major pricing of long-term assets and to drive the bank's bottom line. This is not the case in Brazil, where the negative rate sensitivity has been intensified by a 9% increase in the policy rate in the span of only 6 months. Yet, we do not expect this to burden the business momentum in Brazil, as loan growth remained strong and we expect normalization of the yield curve in 2023. Finally, the end of the ECB long-term funding program will negatively impact Spanish banks. With the funding program contributing to only 1% of its NII, Santander exposure remains minimum compared to Spanish peers.
Moving on to the second point of our investment thesis, we are going to elaborate on the turnaround of the Spanish segment. As you can see in the chart, Spain has been traditionally an underperforming segment for the bank. However, with lower returns, this is still one of the main markets of Santander, which has been dragging down return on equity on a group level. We believe any improvement in this particular segment will likely push up ROTE for the whole group. Moreover, we believe Santander has already laid out the foundations for the turnaround of the segment to happen. The bank led the cost-cutting exercise in Spain, cutting more than 2,000 branches and 4,000 employees in the last 3 years, and it has reduced the cost-to-income ratio by more than any other major competitor in the region. At the same time, operating jaws at 11.5% are much stronger than Spanish peers. We believe these efficiency gains will help the bank to capitalize any improvement in the banking sector outlook and improve return on capital. Why do we think this is going to happen in the medium term? As you can see in the chart on the left, net mortgage production turned positive for the first time in the last 10 years in 2021, and we are confident that recent market share gains in mortgages, supported by stronger pre-provisioning returns than peers, are a leading indicator of further improvement in the region and conversions of returns to the group level.
Thank you very much, Raul. Building on the Spanish turnaround, the market has penalized Santander for its low capital for too long. Unloading risk-weighted assets in strategic areas and working on improving regulatory requirement, Banco Santander has answered to the market's demand. Building on what they deemed as a low buffer zone of 189 bps pre-pandemic, strong organic capital generation, and a wish to close the gap with peers has brought CET1 ratio levels up 300 basis points above regulatory requirement. Basel IV is approaching fast, and Santander has taken the measured approach that we think is demonstrative of strong risk management. Impact expected to remain in the 30 bps region per management, but as previously mentioned, the stable business model and large geographic footprint leaves the company in a comfortable position should regulations be stricter than expected. As demonstrated by the European Banking Authority stress test conducted last year, Banco Santander has proven its resilient business model and ability to withstand important macroeconomic adverse conditions. With strong capital protection by 2023, only generating an impact on CET1 ratios of 240 bips against 500 across European peers. Overall, we feel comfortable with this coverage level and forecast it to remain in the 12% region. With the end of the moratorium suggested on dividends by the ECB during the pandemic, the bank has resumed their 40% shareholder retribution via a combination of dividends and share buyback. We forecast an increase of 42 bips per quarter in total payout ratio, settling at 45% by 2024. ROT approaching 14%, capital ratio sufficiently covered, and share price trading below tangible book value all offer an interesting equity story for further share buyback at attractive recapitalization levels. However, despite this strong shareholder retribution, Banco Santander still trades at a discount. With a 32% discount on the average price to book value ratio among European banks, the market has for long insisted that 1. Low capitalization level, and 2. Conglomerate structure justify it. This market view can also be seen expressed in the implied cost of equity nearing 15%, while its Spanish peers closer to the 11% region.
Let's now dive into our valuation analysis. We based our target price on both intrinsic and relative valuation methods as outlined on this slide. Overall, all of our methods indicate similar levels with upside, and weighting them equally results in a target price of 3.76 euros. For relative valuation, we selected peers for each region that had a similar business model and were large enough for comparison. We looked at both the price to earnings ratio and the price to book value ratio over the next 2 years in our analysis. For the dividend discount model, we looked at each region separately given the huge differences in terms of risks. This is reflected by different levels in both cost of equity and growth rates that we applied, as you can see on the left side of this slide. In this model, the main contributors to value turn out to be Spain, UK, US, Brazil, Chile, and the digital consumer bank. For our justified price to book value ratio, we took the forecasted return on equity over the next 3 years and applied a weighted average cost of equity and perpetuity growth. This resulted in a 48% upside potential. We also conducted a bull and bear analysis with differences in expectations for exchange rates, interest rates, GDP, and unemployment. Particularly noticeable here is that even our bear case scenario results in a 20% upside potential.
The three key risks to our buy recommendation are the foreign currency risk against euro due to potential political instability in Latin America, the risk to miss on a cost-cutting plan because of inflation, and the large exposure to the booming UK mortgage market that can potentially lead to increased loan loss provisions in 2022. Adding to that, there is a new geopolitical risk due to the Russian-Ukraine conflict. As we can see from the table above, Santander's exposure to both Russia and Ukraine remains minimal. Irrespective of how the conflict is going to evolve, we already see it impacting the global growth outlook and the financial sector in particular. As we can see from the chart on the left, the drop in Santander's share price during the most heated period of the conflict still remains lower than on average for its peers. Now let's move to ESG. Santander has consistent A rating across all the three pillars. It is a signatory of PRI and reports in accordance to the Global Reporting Initiative. As we can see from the table on the right, compared to its peers, Santander, while not best in class, is still doing quite well on various ESG-related indices. We see that the bank is setting long-term targets, and we like the pace at which it is meeting them. The main highlights are that are reducing portfolio exposure to high-emitting sectors and deferring up to 36% of variable compensation for executive directors until 2024, subject to meeting long-term targets.
Thanks, Anna. Santander is a hidden bull among Spanish banks. We restate our buy recommendation driven by rate cycle across core geographies, a Spanish segment on the verge of a turnaround, misunderstood capital levels, and finally, an opportunity to close the gap on valuation metric with peers. Thank you very much.
Thank
Maybe I'll
you.
start.
Please go on.
I'll start very quickly. A lot of your investment thesis around the recovery of Spain. How about Latin America? How does the macroeconomic outlook of Latin America impact the share price of Santander?
I can take this one. So the the business momentum in Brazil, because Brazil is the main geography within South America, um, was very strong since the end of the pandemic. I mean, loan growth was positive, and right now we're seeing that loan growth is slowing down, and banks are restricting access to credit. And we're also seeing that the asset quality is starting to deteriorate. So we would not be very bullish on the growth outlook for Brazil as a result. And the second thing with Latin America, which is very important for Santander, would be the effect on foreign exchange. Sorry. If we go to slide um, slide 129, we can see that if in the event that no 120 19, in the event that there is a major deterioration of the Brazilian real, it would have a significant effect on profits at the group level. So growth outlook in Latin America are not as good as they look right out of the gate at the pandemic.
Is that considered in your valuation?
Maybe I can also pitch in. Actually, we took that into account. We have updated our model that depends because a bank's financials, a bank's performance depends a lot, especially for retail banks, on the interest rate levels and the yield curve, right? And so we have updated it according to the latest forecast of the interest rates in each of the region that Santander is involved in South America. So that is priced in our model, yes. And we have also adapted the provisions given the risks that we see in each one of the countries separately. If you wish, we can also go more into details. We have the financials here. Maybe Anna, just to briefly show, or could you, Anna, just to briefly show? Yes, you can see here that we forecasted every region separately. So yes, it is priced in.
Okay. Thanks.
Well, in the Mexican market, Citibank is selling its retail business, and Santander has mentioned that they have interest in buying or be one of the bidders of the bank. This is expected to be between 10 and 15 billion US dollars. So, do you think that if they go and buy the retail business of Citi in Mexico, can impact the capital structure, especially after the capital misunderstanding by the market that you mentioned, and the impact on your valuation, please?
So I can begin with that one. So thank you very much for your question. If it is true that a city is trying to sell Banamex, so in Mexico, but in our point of view, we don't believe that Santander will actually go for it, despite having said it openly in their last earnings call that it should maybe be a consideration in Q3 2022. But we do not believe that they will engage in it because it will first eat a lot of capital. They expect it to hit the capital ratios in approximately between 70 basis points and 130 basis points. So we do not believe in terms of capital structure that right now Santander is well positioned to take advantage of this opportunity in the Mexican market.
And maybe to shortly add on that, it is also unlikely that Santander will actually be allowed from the Mexican government to acquire Banamex, because it would mean that but it would mean that Santander and BBVA both will control, I think, more than 50% of the market in Mexico, and that would create something close to a duopoly, and it is likely that the Mexican government will not allow for that. So we do not see it as likely to be happening.
I have a question about you compare peers based on the common equity tier one ratio, and I have a problem that you in this ratio you're using risk-weighted assets, and it depends on national regulation, different characteristics of the banks. Have you compared the same peers just purely on the leverage ratio? Because it's a common practice to use both ratios together to see the differences.
So I can begin with that. So if I understood correctly, you're wondering if we've also checked the leverage ratio with the CET1 ratio. So in terms of CET1 ratio, Santander is actually, if Anna, you can take us to slide 41. So Santander, due to its global systematic importance, they are required. They are actually required to post a 1% over CET1 ratio of capital to protect it. And in addition to that, they are also forced by the Spanish regulation and bank. If you go to the next slide, they are also obliged by the Banco de España to post a certain level of collateral as they represent an important weight into the banking sector in Spain.
Okay, I was just wondering about purely financial leverage ratio, if you have looked at that one.
If you go back, I am not sure I have it right now in the deck.
Actually, if you go to slide 83 on the peer selection, you will see that these are the metrics that we looked at when we selected the peers for each of the region, because we wanted to analyze each region separately and to do our sum of the parts analysis. And these are all of the metrics that we looked at. So the level of leverage itself was not a key criteria for us.
Okay, and one more quick question. I saw on the slide that you attributed some probabilities to the outcomes of the Russian-Ukrainian crisis. How did you come up with those numbers?
Right. I could take this question. So when we're assigning probabilities, we actually analyze certain reports from available sources and flow from Bloomberg research that were analyzing the conflict. At the period when we were first doing it, the first scenario seemed more possible. Now it looks like we are in the second scenario, actually, but yeah, the source for it was basically Bloomberg and the other external data providers.
Well, Santander recently announced that the share buyback program was completed. And I wanted to ask you, without this buyer, how could the stock react, or is this considered in your model because they are not going to have the same support for the price of the stock?
Yes. So as you said, Santander has actually finished quite recently their share buyback program, but we expect them to continue probably end of the year to support the price. Not to support the price, but as the price offers quite an interesting, as the stock right now represents an interesting price for them to buy, we believe that at the end of the year they will resume it with their dividends, because in their last earnings call, actually management was committed towards continuing on their paths of shareholder retribution, which they had to stop during the pandemic. So right now, as you said, they are stopping it, but we believe that probably Q3 or Q4 2022, they will resume it back. Yeah.
I'm just wondering this 42% upside. what you see then the market doesn't see.
Maybe I can answer to that one. So actually, the 42% upside might look a bit exaggerated at the moment because there was a recent a drop in the share price. And if you go on the slide 32, you will see at the very end that there is a drop right now that happened. And we feel that this is unjustified. This is, of course, due to the fact that there is a possibility that Europe goes into a recession because of the increasing prices and the Russia-Ukraine conflict. But we do not see Santander, as Anna was explaining before, as being directly affected by it, which is why we still remain bullish on all of our main investment thesis, and that's why the 42% might seem a bit bigger. Other than that, our main investment thesis points are something that we believe the market has not priced in.
And just to add on, Kevin, on the last earnings call, we've actually been seeing one of our investment thesis, namely the Spanish turnaround, materializing partially, not fully, but there is a signal that the Spanish segment is actually cutting costs and will be a good value provider in the next year.
A lot of your analysis is focused on the geographical, difference. How about in terms of industry exposure? How is the loan book exposed to different industry, and how does that impact the analysis?
Yeah, so I think I can take that one. So Anna, if you can go to the slide number, it's asset quality, slide 49, Appendix C.
Sure.
Yeah, you can go to the next slide, please.
Mm-hmm.
Yeah, so we actually thought it was very important to take a look into this because with COVID-19, we wanted to know which kind of exposure to industries our bank has compared to other banks. We did that analysis with peers in the Spanish market. But as you can see, we listed all the industries by how much how much impacted by COVID-19 they were. And actually, Santander in the first table you can see is the bank with less exposure to the four most affected industries by COVID-19. So in that sense, we feel the bank is protected because even though COVID-19 it was already 2 years ago, these industries haven't recovered yet, especially in Europe. So it's still a problem to have a high exposure to these industries in the loan book. So in that sense, we feel protected with the asset quality of the bank.
And just to build on that, if we go to slide 35, so this is the loan book exposure in terms of the breakdown between mortgages, consumer, and corporates, and they've got quite large exposure to mortgages. But of course, this varies from country to country, and it's different for every geography.
A quick question: what would you, or what factors would make you change your recommendation?
Maybe I can jump in that one. The main thing that we would see right now would be the recession in Europe actually taking form, because that would impact, of course, the loan growth, and therefore our net interest income, our forecasted net interest income for Santander. And that would also mean that higher provisions would be needed, and of course that is the biggest risk that we see today for Santander's, and that would change our valuation downwards. It would have to materialize more, and right now we don't see it as being 100% sure, but that would be the biggest potential change in our valuation.
Yeah, if I may add something to this, we've also been looking at the provisioning policy of the bank compared to other banks, and we feel like Santander has been provisioning more has been doing more provisions than other banks. So in that sense, even if we see a recession, we feel like the bank will be more protected
Time.
than
Thank you.